Right now, your life savings might actually be sitting in a bank that, well, doesn't even exist.
Which is kind of a terrifying thought when you just say it out loud like that.
Right. But, I mean, think about it for a second. There are no physical vaults, no tellers sitting behind bolt-proof glass, no federal banking charter even.
Yeah, just, elegant lines of code living on a server somewhere.
Exactly. And if you think that sounds like some fringe sci-fi experiment, consider this. According to the banking data platform Plaid, these app-based platforms had about 150 million users globally back in 2021.
Oh, wow, that's already huge.
Yeah, but wait, by 2026, they're projected to hit a massive 350 million users.
That is just, we are witnessing a fundamental rewiring of how humanity interacts with capital.
Right.
Hundreds of millions of people are literally migrating away from legacy institutions that have, dominated the financial landscape for over a century, and they're choosing to trust their paychecks to fintech startups.
And that migration is the entire focus of our deep dive today. We're pulling apart a comprehensive guide titled The Digital Frontier, a guide to neobanking essentials.
It's a really fascinating source.
It really is. So the mission here is to demystify what a neobank actually is, right? We want to break down the mechanics of how they operate without charging you endless fees.
Yeah, and ultimately help you determine if your money belongs in a traditional physical vault or, out there on the digital frontier.
So to really understand how we get to a staggering number, like 350 million users, we kind of have to look at the historical context, right? Where did these companies even come from?
Right. Well, first, the term neobank literally just translates to new bank. Though out in the industry, you'll frequently hear them referred to as challenger banks.
Challenger banks.
Got it.
Yeah.
Yeah. They are financial technology or fintech startups that operate completely digitally. Zero physical branches, zero brick and mortar footprint.
Which means no driving to the bank on your lunch break, right? No waiting in a massive line, hoping you make it back to the office in time. Literally everything happens on a smartphone screen.
Exactly.
But what fascinates me is the timeline here. These didn't just pop up overnight. The guide points out they started emerging in the 2010s, which is a highly specific and pretty volatile moment in modern financial history.
Oh, the timing is probably the most critical piece of the puzzle. The 2010s were the immediate aftermath of the Great Recession.
Right, of course.
You had an entire generation of consumers, particularly millennials, who had just watched the traditional banking establishment trigger a massive global financial crisis.
Yeah. Public trust in legacy banks was just absolutely decimated.
Completely. People were watching their parents lose their homes or their retirement funds, while the institutions responsible were literally getting bailed out.
It's hard to imagine a worse public relations environment for traditional banks, honestly.
Right. And you add to that the technological revolution happening at the exact same moment. The first smartphones were becoming ubiquitous. App stores were totally changing how software was distributed.
So it was just a perfect storm.
Exactly. Deep, systemic disillusionment with the old guard, paired with the sudden ability to, put a supercomputer in every consumer's pocket. These fintech startups realized they didn't need to build 1,000 physical branches to compete. They just needed to build a better app.
That actually brings up an analogy I was kicking around while looking at the research for this.
Oh, yeah. Let's hear it.
So the traditional banking experience feels a lot like walking into a massive, sprawling department store.
Okay, I can see that.
Right. You go in just because you need to buy a pair of socks. But to get to the socks, you have to navigate past the perfume counters, the luxury watches, the heavy appliances.
Yeah, dodging the salespeople.
It's exactly. The bank offers wealth management, commercial lending, 30-year mortgages, auto loans. It has literally everything, but it is incredibly exhausting to navigate when you just want one simple thing.
Right.
A neobank, by contrast, is like a highly specialized, sleek boutique app on your phone.
Yeah.
It doesn't sell heavy appliances. It really sells socks. But, the checkout process is flawless, the design is beautiful, and it takes you exactly 10 seconds.
That captures the philosophical divide perfectly, honestly.
Right.
Legacy banks attempt to be all things to all people. Neobanks, they focus almost exclusively on daily spending and saving.
Just stripping away the clutter.
Right, stripping it away to make the user experience as frictionless as possible. They build budgeting tools and savings trackers directly into the dashboard, so the app isn't just a passive holding pen for your money, it's an active management tool.
Okay, but boiling banking down to a sleek app brings up a glaring mechanical question for me.
Sure.
How do they actually function under the hood? I mean, a beautiful user interface is great and all, but we are talking about people's life savings here.
Yeah, the stakes are high.
Right. So how do they afford to operate, let alone offer zero fees, if they're basically just startups?
The secret sauce is entirely about overhead. I mean, picture the balance sheet of a traditional legacy bank for a second.
Okay.
They are paying for prime commercial real estate in thousands of cities. They pay property taxes, construction costs, utilities, and this is huge. The salaries of the tellers, branch managers, and security guards inside every single one of those buildings.
Wow. Yeah. That requires billions of dollars just to keep the lights on.
Exactly.
Which explains why my old bank used to charge me a $12 monthly maintenance fee just for having a basic account, plus a penalty if my balance dropped below a certain number.
Right, they had to pay for those marble columns in the lobby somehow.
Literally.
And that is exactly where the disruption happens. Because neobanks operate 100% digitally, they completely eliminate that physical overhead.
Oh, I see. Yeah, they take the massive savings from not having a real estate portfolio and pass it directly back to the customer. That is how they can offer accounts with zero monthly fees, no minimum balance requirements, and even like higher interest rates on savings.
And features like giving you access to your direct deposit paycheck 2 days early, right?
Yeah.
I saw that in the guide.
Yes, exactly.
But wait, if they aren't charging the consumer any monthly fees, how on earth are these startups actually making money? I mean, they are businesses after all. They aren't doing this for charity.
That's the big question. So they rely heavily on something called interchange fees.
Interchange fees, what's that?
Whenever you go to a coffee shop and buy like a $5 latte with a debit card, the merchant pays a small processing fee to the card network, like Visa or MasterCard.
Right, okay.
The neobank actually takes a cut of that fee. So they don't need to charge you $12 a month. They just need you to use their bright neon debit card for all your daily purchases.
Oh,
If you have millions of users buying lattes and groceries every single day, those microtransactions add up to a highly profitable revenue stream.
okay. That makes complete mechanical sense. But we really have to clarify a major distinction here because people often confuse neobanks with online banks.
Mm-hmm.
Are they just the same thing?
Oh, no, they're completely different animals.
Really?
Yeah. An online bank is generally just the digital division of a traditional banking institution. They might still charge legacy fees, and they often benefit from an established branch network somewhere in the background. And this is the most important part. They hold their own federal banking charters and direct deposit insurance.
Okay, so what about neobanks?
A neobank is a standalone tech company. It prioritizes the low-to-no fee structure, and this is the biggest catch in the entire industry. They almost never hold their own federal banking charter.
Wait, let's stop right there because this is where the system feels inherently risky to me.
I get that.
If neobanks do not have their own federal regulation standards
Mhm.
or a direct charter like a regular bank, isn't that incredibly dangerous? Like if a fintech startup goes bankrupt or their servers crash, does my money just vaporize into the cloud?
That is the single most important mechanism a consumer needs to understand before moving their money.
Okay, so how does it work?
Well, obtaining a federal banking charter in the United States is a brutally difficult process. It takes years of regulatory red tape and millions of dollars in capital just to apply.
Right.
Fintech startups want to move fast, obviously. So instead of spending 5 years trying to become a bank, they essentially rent the legal framework of an existing one.
Rent a charter. I'm picturing this like buying a car. A neobank is essentially the sleek, futuristic body and touchscreen dashboard of a Tesla. But if you pop the hood, the actual engine making the car move was built by Ford.
That is a brilliant way to visualize it, honestly. The neobank builds the software, the app, the customer interface, and the branding. But they partner with a traditional, state, or federally chartered regional bank operating in the background.
Oh, I see.
That shadow partner bank is the entity that actually holds your deposits.
Yeah.
And because the partner bank holds the charter, they are the ones who provide the FDIC insurance.
Okay, and just for anyone fuzzy on that acronym, the Federal Deposit Insurance Corporation, the FDIC, is the U.S. government agency that basically guarantees your deposits up to $250,000 if the bank fails. It's the ultimate safety net.
And that safety net is totally non-negotiable. The source guide makes it incredibly clear here. You must proactively verify that a neobank's partner bank offers pass-through FDIC insurance.
You can't just assume.
Right. You
Yeah.
cannot just assume you are protected because the app's marketing looks slick. You really have to read the fine print and find that FDIC logo.
That is such a crucial point. So because they are essentially tech companies piggybacking on other banks' charters, they don't have to follow the rigid traditional blueprint of what a bank is supposed to look like.
Exactly.
And that freedom allows these apps to mutate and target highly specific demographics, right?
Yeah.
It feels less about picking a utility and much more about picking a lifestyle brand.
Completely. When you remove the legacy constraints, you open the door to massive specialization. The market is incredibly diverse right now, with different companies solving vastly different consumer pain points.
Let's actually look at how that plays out in reality by grouping some of the major players that were highlighted in the research.
Yeah.
First up, you have what I would call the values brands.
Right.
And the standout here is a company called Aspiration. They are founded entirely on ethics and sustainability, specifically targeting people with heavy climate anxiety.
Yeah, Aspiration recognized that many consumers were just furious learning their traditional banks were using their deposits to fund, like, fossil fuel projects.
Oh,
So Aspiration built an alternative. Their debit card actually earns cash back when you make purchases at eco-friendly businesses.
and their stated corporate goal is wild. They want to plant 1 billion trees by 2030, funded just by everyday transactions. But the craziest part of their model is the fee structure. Customers literally pay what is fair.
Yeah, it's pretty unique.
You literally type in what you think the monthly fee should be, even if you decide that number is 0.
Which works beautifully because, as we discussed earlier, their actual revenue engine is the interchange fee from the debit card swipes.
Oh, right, the coffee shop logic.
Exactly. They turn financial utility into a mechanism for social impact, which breeds a level of customer loyalty a traditional bank could literally never dream of.
That's brilliant. Okay, so then you move from the niche values brands to what we could call the utility disruptors. These are the giants focusing entirely on financial inclusion and solving the most hated aspects of banking.
Yeah, and Chime is the undisputed heavyweight here. I mean, they have a massive user base of over 38 million customers.
38 million. That's
Yeah.
huge.
It is. And to scale to 38 million users, you have to solve a ubiquitous problem. Chime looked at the landscape and realized the overdraft fee was the most universally despised banking mechanic in existence.
Oh, totally.
Traditional banks were making billions of dollars a year penalizing people for running out of money.
Right, which makes no sense when you think about it.
Yeah.
So Chime's entire mantra became profiting with customers, not from them. They eliminated overdraft fees, monthly service fees, and ATM fees entirely.
Just wipe them out.
Yeah. No security deposits, no credit checks, no minimum balances. They basically took a red pen to everything people hated about banking and deleted it.
And you see a very similar strategy with Garo, too. They brand themselves as a bank for all of us, and they're currently serving 7 million customers.
Oh, wow.
By completely removing credit checks and minimum balances, Varo is deliberately opening up the financial system to people who have been marginalized, rejected, or just priced out of traditional banking institutions.
And Current operates in that exact same lane, right? With over 4 million customers.
Yep, 4 million.
The guide notes they lean heavily into transparency. They also follow a strict no-fee approach for overdrafts, minimum balances, and in-network ATMs, though out-of-network fees can still apply.
Yeah.
The appeal there is just absolute predictability.
Yeah.
You know your money isn't going to slowly bleed out through hidden charges.
Exactly. Then you have a company that completely flips the script on geography. Revolut. They were originally founded in Europe and brought their platform to the US in 2020.
Right.
They now boast over 50 million users worldwide.
50 million.
Yeah, and their entire value proposition is borderless finance.
Which is incredible if you are an international traveler, a digital nomad, or just living between two countries.
Huh.
I mean, trying to deal with exchange rates and foreign transaction fees at a traditional bank is an absolute nightmare.
It really is.
But Revolut actually supports 33 different currencies directly right there in the app.
They do. But Revolut's most revolutionary feature isn't just for jet setters. It fundamentally changes the game for immigrants, international students, and temporary workers. While traditional U.S. banks require a social security number or an ITN, an individual taxpayer identification number,
Yeah.
which the IRS issues to foreign nationals, just to open a basic checking account.
And getting an ITN can take months of government paperwork.
Months.
So if you just arrived in the country for school or work, you are effectively locked out of the financial system. You can't even deposit a paycheck.
Exactly. But Revolut bypasses that entirely. They allow non-U.S. residents to open an account using just a U.S. visa. By utilizing different digital identity verification methods, they tear down a massive bureaucratic wall.
That's amazing.
Yeah, they're providing financial infrastructure to people the legacy banks simply ignore.
So hearing all this, the pros here are incredibly compelling. If you are digitally fluent, you get 24/7 mobile access. Your banking fits your schedule, not the other way around.
Right.
You save actual cash by avoiding legacy fees, and you can get your paycheck 2 days early. It's fast, it's cheap, and it's literally always in your pocket. But we need to look at the other side of the ledger.
Of course.
Beyond the constant need to verify that third-party FDIC insurance, what are the glaring cons here?
The most significant drawback, by far, is the total absence of face-to-face interaction. I mean, neobanks are incredibly efficient when everything goes right,
Sure.
but the moment something goes wrong, say you are the victim of identity theft or, a complex fraud situation locks up your account, you cannot just walk into a lobby, show a manager your driver's license, and demand a resolution.
Oh, that's true. You are at the mercy of an automated chatbot, submitting support tickets through an app, or waiting on hold with a distant call center while your rent is literally due.
Right. And that lack of human escalation is a huge anxiety point for a lot of people.
Yeah, I can totally see that.
It requires a massive shift in how you view customer service.
Yeah.
You are trading the physical safety net of a local branch manager for the convenience of zero fees.
Which actually brings up a limitation in their services that I want to push back on a bit.
Okay, lay it on me.
The guide makes it clear that neobanks focus almost exclusively on core services. Checking, savings, debit cards. You cannot get a 30-year mortgage through Chime.
No, you can't.
You can't walk into Revolut and ask for a specialized small business loan or auto financing. So, looking at the natural life cycle of a consumer, we don't stay 22-year-olds renting apartments forever.
Sure.
Aren't neobanks just a temporary stepping stone? Like, won't you eventually be forced to go crawling back to a traditional bank when you need to buy a house or a car anyway?
That is a very pragmatic critique, and honestly, it strikes at the heart of your department store analogy from earlier.
How so?
When it comes to complex, highly individualized underwriting like evaluating your risk for a $500,000 mortgage, legacy banks absolutely still own the infrastructure. But utilizing a traditional bank for a mortgage doesn't mean you have to abandon your neobank.
Oh, I see. You just separate the functions.
Precisely. We are rapidly moving toward an unbundled financial future. Your neobank becomes your daily driver. It's the app you use every single day to buy coffee, split dinner bills, track your budget, and receive your salary.
Right.
You might only interact with a traditional legacy lender twice in your entire life. Once for the auto loan, once for the mortgage. You don't have to keep your daily checking account at the department store just because you bought an appliance there once.
That reframes the entire decision for me, honestly. You are building a customized financial toolkit.
Exactly.
So when we look at the ideal user profile, neobanks are perfect for people who prioritize digital convenience to avoid branch hassles. They are for fee minimizers who are just tired of being nickeled and dimed for their own money.
Yeah, 100%.
And they are an absolute lifeline for global citizens and non-U.S. residents who are locked out by traditional paperwork.
They are a really powerful instrument for money management, provided the consumer is proactive. You have to understand that your deposit protection comes from a partner bank. You have to read the fee structures carefully, especially regarding out-of-network ATMs.
Right, no skipping the fine print.
Exactly. And you have to be totally comfortable managing your financial life without ever looking a bank teller in the eye.
So the most actionable takeaway here is to actually pull up your current traditional bank statement. Look at the maintenance fees you paid last year. Look at the fractional pennies you earned in interest.
It's usually a pretty sad number.
It really is. Compare those real numbers against the offerings of a challenger bank. Doing the math on your own lifestyle is literally the only way to make a truly informed decision about where your money belongs.
The tools to optimize your finances are more accessible than ever, but they do require you to take the wheel.
Absolutely. But before we wrap this up, I want to leave you with a provocative thought to mull over, building on that incredible realization about international students and digital verification. If these financial platforms no longer require physical branches in your neighborhood, if they bypass local charters by renting infrastructure, and in some cases don't even require traditional Social Security numbers to function, what happens when our financial identities become completely decoupled from our physical geography.
Oh, wow. It challenges the very definition of what a local economy even
It
is.
really does.
Yeah.
Are we rapidly accelerating toward a future where the concept of a local bank is entirely borderless? Where your money exists purely in the digital ether, completely untethered from the constraints of the physical world or, the country you happen to be standing in? It really makes you wonder if that heavy, immovable, traditional steel vault is finally becoming obsolete, replaced entirely by a few lines of code living quietly in your pocket. Until next time, keep diving deep.